What if I told you some of the best stock market opportunities are hiding in plain sight, ignored by most investors? While everyone chases the same tech giants, there's a world of undervalued companies quietly building the future. Today, I'll break down 5 tech stocks I believe are seriously undervalued right now. We'll cover a digital transformation leader, a travel tech engine, a fintech powerhouse, a customer experience innovator, and a marketing software giant. These picks have real long-term growth potential. If you want to get ahead of the curve, you're in the right place. Let's dive in. First up is Endava, ticker DAVA, a company that's quietly become a backbone for legacy businesses making the leap into the digital age. Endava guides massive corporations through every stage of digital transformation, from migrating to the cloud, to automating workflows, to unlocking insights with advanced data analytics. They're the reason your banking app or insurance portal feels modern, intuitive, and secure, making everyday digital experiences seamless for millions. The demand for digital transformation is exploding, and Endava's client base stretches across finance, healthcare, retail, logistics, and more, virtually every sector that needs to modernize to stay competitive. This broad diversification shields them from downturns in any single sector, giving them resilience even when one industry faces headwinds. Their land and expand strategy means they start small with clients, prove their value, and then grow those relationships into multi-year, multi-service partnerships. Endava's global delivery model, leveraging top-tier talent in Central Europe and Latin America, keeps costs low, margins healthy, and allows them to scale quickly for clients worldwide. They're not just catching companies up to today, they're preparing them for tomorrow with investments in AI, machine learning, and IoT, helping clients future-proof their operations. Their client list includes blue-chip names, and their reputation for reliability and innovation is rock solid. CEO John Cotterell's long tenure and clear vision have driven consistent growth, steering the company through industry shifts and global challenges. The stock has dipped with the broader tech sell-off, but the company's fundamentals remain strong and intact. The market is focused on short-term noise, overlooking Endava's long-term runway and the secular growth in digital transformation. Risks. Sure, a recession could slow IT spending, but digital transformation is now mission-critical for survival, not just a nice-to-have. Endava's cost advantage, sticky client base, and relentless focus on next-gen tech make it a compelling long-term play, even in uncertain times. The market is mispricing Endava, lumping it in with speculative tech when it's actually a high-quality, profitable service business with real staying power. This is the kind of undervalued gem I love. Strong fundamentals temporarily out of favor and positioned for a rebound as sentiment shifts. If you believe in the digitization of everything, Endava absolutely deserves a spot on your watch list. The real opportunity is in the disconnect between short-term sentiment and long-term value, a gap that savvy investors can exploit. Endava is quietly powering the future behind the scenes, while Wall Street is too distracted to notice. For patient investors willing to look past the headlines, this could be a rare and attractive entry point. The company's global reach, deep client relationships, and robust innovation pipeline truly set it apart from the pack. Endava's growth isn't a flash in the pan, it's built on real recurring demand and long-term client partnerships. As more businesses modernize and upgrade their systems, Endava stands to benefit in a big way. Their execution is top-notch, and their client loyalty is hard to match in the industry. In a world obsessed with hype and speculation, Endava is quietly delivering substance and real results. That's why it's firmly on my radar as a stock to watch. Let's move to the next pick. Next up is Sabre Corporation, ticker SABR, a company that's truly the tech backbone of the global travel industry, yet remains largely invisible to most travelers. Every time you book a flight, reserve a hotel room, or even rent a car online, there's a good chance Sabre's powerful software is quietly powering the transaction behind the scenes. Their global distribution system, or GDS, acts as a digital bridge, connecting airlines, hotels, and travel agencies across the world, enabling seamless bookings and real-time inventory updates. The pandemic brought global travel to a standstill, crushing demand and causing Sabre's revenue to plummet. But now, as borders reopen and travelers return, the industry is roaring back to life. Booking volumes are steadily recovering, yet Sabre's stock price still lags behind. The market seems to be pricing in risks that are no longer as relevant, creating a potential disconnect. Sabre isn't just waiting for a rebound, they're actively innovating. The company is migrating its infrastructure to the cloud with Google and rolling out advanced AI-powered tools to help airlines optimize everything from pricing to scheduling. Their Airline Solutions division delivers essential deeply integrated software for flight operations and revenue management. Once an airline adopts Sabre's platform, switching is costly and complex, locking in reliable, recurring revenue streams. The GDS market is a classic oligopoly, with just a few major players and extremely high barriers to entry. 𝗟𝗡's competitive moat is wide and defensible, making it hard for new entrants to disrupt. Of course, there are risks. 𝗟𝗡 took on significant debt to survive the pandemic downturn, but with travel rebounding and cash flow improving, they're now in a position to start paying it down. Airlines are pushing for more direct bookings, but 𝗟𝗡's expertise in handling complex itineraries and its dominance in corporate travel keeps its value proposition strong. Business travel, which is especially lucrative for 𝗟𝗡, is rebounding and providing a high-margin tailwind as companies resume in-person meetings and conferences. Meanwhile, 𝗟𝗡's hospitality solutions segment is expanding, offering hotels and resorts new technology to streamline operations and enhance guest experiences, unlocking even more upside. Investing in 𝗟𝗡 is essentially a bet on the sustained recovery and future growth of global travel. The company weathered the worst crisis in its history and is emerging leaner, more efficient, and technologically advanced. The market has been slow to recognize this turnaround. For value investors, 𝗟𝗡 represents a classic recovery play, an undervalued stock with significant upside potential as the travel sector normalizes. The risks are real, but so is the potential reward. 𝗟𝗡's technology is absolutely essential to the modern travel ecosystem, powering millions of journeys every day. As travel demand continues to normalize, 𝗟𝗡's improving fundamentals should become more apparent. The gap between its stock price and business recovery is the opportunity for investors willing to look deeper. If you believe in the enduring, long-term demand for travel, 𝗟𝗡 is worth a closer look. The company is well positioned to ride the next wave of travel technology innovation. Don't overlook the unseen engine behind your next trip. 𝗟𝗡 is quietly powering the future of travel. Now let's move on to fintech. Third on our list is Fiserv, ticker symbol FISV, a fintech giant that quietly powers the digital payments ecosystem from behind the scenes. While it may not be a household name like some of its flashier competitors, Fiserv is absolutely essential to the way money moves in our modern world. If you've ever swiped a credit card at a store, paid a bill online, or made a digital payment, there's a good chance Fiserv was the company processing that transaction in the background. Their Clover platform is a leader in merchant payment solutions, especially for small businesses looking for a simple, all-in-one system to handle sales, payments, and more. Clover isn't just a card reader, it's a full business management system, offering inventory tracking, analytics, and customer engagement tools. This makes Fiserv's revenue sticky and recurring, as businesses rely on these services every day. Beyond merchants, Fiserv also provides core processing technology for thousands of banks and credit unions, handling everything from account management to transaction processing. Switching away from Fiserv is like a heart transplant for a bank. Rare, risky, and extremely disruptive. That's why most financial institutions stick with Fiserv for years, if not decades. So why is Fiserv undervalued? Despite being a mature, highly profitable company, it often gets overlooked by investors in favor of newer, flashier, fintech names that make more headlines. Its valuation remains reasonable, even as it generates massive free cash flow year after year, fueling growth and rewarding shareholders. Fiserv uses that cash to buy back shares, which steadily boosts value for long-term investors and signals management's confidence in the business. The acquisition of First Data transformed Fiserv into an end-to-end payments powerhouse, serving both merchants and banks, with a comprehensive suite of solutions. The long-term trend is clear. Cash is dying, and digital payments are booming. Every year, more consumers and businesses shift to digital transactions. Fiserv is a direct beneficiary of this global shift, as its technology enables seamless payments across borders and industries. Their scale, advanced technology, and deep integration with clients give them a wide moat in both merchant and banking segments, making it tough for competitors to dislodge them. Of course, there are risks. A severe recession could slow payment volumes, and competition from both legacy players and new fintech startups is always a threat. But Fiserv's diversification across products, clients, and geographies, along with its massive scale, help mitigate these risks and provide stability. The market is underestimating Fiserv's quality, durability, and its ability to adapt to the ever-changing financial landscape. It's being valued like an old-world financial company, but in reality, it's a tech leader at the very heart of the digital economy, driving innovation every day. For investors seeking steady, reliable growth and the power of compounding, Fiserv is a classic, get-rich-slowly stock, one that rewards patience. It won't double overnight, but it's built for the long haul, with a business model designed to endure and thrive over time. The digital payments wave is just getting started, and Fiserv is perfectly positioned to ride it for years to come. Fiserv's fundamentals are rock solid, with a proven track record of performance and resilience. This is a stock to buy, hold, and let time do the work. an anchor for any long-term portfolio. If you want exposure to the future of money and the infrastructure that makes it possible, Fiserv is a top pick. Next, let's talk about how Fiserv is shaping the customer experience in the digital age. Fourth is NICE, ticker NICE, an Israeli tech leader in cloud-based customer service software. Whenever you contact support, NICE's platform may be powering the interaction. Their CXOwn platform moves call centers from clunky hardware to flexible AI-powered cloud solutions. This shift is a massive tailwind, making customer service smarter and more efficient. NICE's AI analyzes calls in real time, gauges sentiment, and guides agents, improving satisfaction and cutting costs. For businesses, it's a triple win. Happier customers, lower costs, and more efficient operations. NICE is the clear leader in contact center as a service, with more customers and features than competitors. Their omnichannel platform manages voice, chat, email, and social, all in one place. The more interactions they process, the smarter their AI gets, a powerful data network effect. The market sold off cloud software stocks, but NICE's fundamentals remain strong. They're highly profitable with a proven scalable business model. Risks include competition from tech giants and potential delays in cloud adoption during downturns. But NICE's focus and head start give them an edge. Their management team has successfully led the transition from hardware to cloud. The total addressable market is huge and growing as customer interactions multiply across channels. NICE's valuation is now at a discount to its growth prospects. For investors who can look past short-term noise, NICE offers a compelling risk-reward. They're the brains behind modern customer service, and the market is underestimating them. As AI and cloud adoption accelerate, NICE stands to benefit. Their data advantage is hard to replicate. NICE is a bet on the future of business-customer interactions. If you want exposure to the AI-driven customer experience revolution, keep an eye on NICE. Let's wrap up with our final pick. Last up is HubSpot, ticker HUBS, the pioneer of inbound marketing software. HubSpot's all-in-one platform helps businesses attract, engage, and delight customers, especially small and mid-sized companies. Their free CRM is the gateway, with premium hubs for marketing, sales, service, and website management. The model is brilliantly scalable. As customers grow, they upgrade and expand within the HubSpot ecosystem. This creates sticky, recurring revenue and high net retention. HubSpot targets the massive, underserved SMB market, where giants like Salesforce are too complex or expensive. Millions of businesses still use spreadsheets or patchwork tools. HubSpot offers a better way. The platform's integration makes switching costs high, locking in customers. International expansion is a huge growth driver, with Europe and Asia-Pacific just getting started. The leadership team, including co-founder 𝗗𝗟𝗏 𝗟𝗢, is legendary in marketing circles. HubSpot's culture and brand are major assets, fueling innovation and customer loyalty. Risks: SMBs are more vulnerable in downturns, but HubSpot's customer base is diverse and its software is mission-critical for many. The market is overly focused on short-term macro risks, ignoring HubSpot's long-term potential. The recent pullback has created a more attractive entry point for long-term investors. HubSpot is building the front-office platform for the next generation of businesses. Their growth runway is enormous, and their competitive moat is strong. The stock isn't cheap, but quality rarely is. For those with patience, HubSpot offers a shot at outsized returns. If you believe in the digital transformation of sales and marketing, HubSpot is a must-watch. That wraps up our 5 undervalued tech stocks. There you have it. 5 tech companies trading below what I believe is their true value, each with unique strengths. Each one has a strong competitive edge and is quietly building long-term value while the broader market chases hype and short-term trends. Finding these kinds of opportunities takes patience, thorough research, and a solid investment framework to guide your decisions. Remember, these are just my personal opinions. Always do your own research and due diligence before investing your money. Which of these business models do you find most compelling or promising for the next decade and beyond? Let me know your thoughts and opinions in the comments below. Don't forget to like, share, and subscribe for more insights and future updates. Thanks for watching, I appreciate your support, and I'll see you in the next video.